people are lining up around city blocks, not for the new iPhone, not for concert tickets, but for gold. The price just hit $4,400, a 60% surge this year alone. Central banks are hoarding it faster than they have since the 1950s. And some very smart people are whispering that this isn't just another market fad. They're saying this is the beginning of the end. Of the dollar. Are they right? Stick around. Because what I found might surprise you. Right now, we're witnessing something remarkable. Gold and silver have both exploded to all-time highs. Search interest for buy gold has never been higher. In Australia and Vietnam, dealers are overwhelmed with customers. Even Trump's decorating the Oval Office with it, though I've been told some of it is just spray-painted plastic, which is awkward. But here's what's really interesting. It's not just retail investors panicking. The biggest buyers? Central banks. The same institutions that spent decades selling gold are now buying it at record pace, over 1,000 tons per year for the past 3 years. And for the first time since 1996, central banks now hold more gold than U.S. Treasury bonds. That shift, that's what has people talking about the debasement trade. So what exactly is the debasement trade? Think back to ancient Rome. Rulers would slowly mix cheaper metals into gold and silver coins, debasing their currency. Trust eroded. Eventually, collapse. Fast forward to today. Some very prominent investors, Ray Dalio, Ken Griffin, Jamie Dimon, are pointing at ballooning U.S. debt, political chaos, and yes, that 10% decline in the dollar's value this year, and asking, are we watching history repeat itself? The theory goes like this. The U.S. is drowning in debt with deficit spiraling. Political instability is shaking confidence in American institutions. Trump's attacked the Federal Reserve, attempted to fire board members. We just had the second longest government shutdown in history. And it's not just the U.S., France, Japan, and others are in turmoil too. Add it all up, and some believe we're witnessing the early stages of a global shift away from the dollar, a return to gold as the ultimate store of value. It's a compelling story, dramatic, almost inevitable sounding. But here's where things get interesting. Because when you actually dig into the data, the debasement narrative starts to fall apart. First, the dollar itself. Yes, it's down 10% this year, but since April, basically flat. Meanwhile, gold has surged 30% in that same period. If this were really about dollar collapse, those lines should move together. They don't. Second, inflation expectations haven't budged. If people genuinely believed the dollar was being debased, we'd see inflation expectations skyrocketing. We don't. Third, Treasury bonds. If the world was abandoning the dollar, Treasury prices should be tanking. Instead, they've actually increased since May. Fourth, and this is crucial, which central banks are actually buying. The headlines make it sound like the entire world is rushing into gold, but the biggest buyers this year? Poland, Kazakhstan, Turkey. Important countries, sure, but not exactly the global financial powerhouses. China, India, Russia, they're buying too, and yes, they have reasons to move away from the dollar. But when you survey central banks globally, most aren't planning to increase their gold reserves. The ones that are? Primarily emerging markets. The major financial powers? They're sitting this one out. Why? Because central banks need liquidity. They need to transact quickly when enacting policy. Gold is liquid-ish, but selling it can drag down prices. U.S. dollars and treasuries? You can borrow against them instantly. Plus, gold is expensive to store, generates zero income, and, here's the kicker, it just experienced a 60% surge. Not exactly the ideal time to pile in. And here's my favorite irony in this whole story. Everyone's debating dollar versus gold as if they're opponents. But guess who holds the most gold in the world? The United States. That's right. The U.S. Central Bank stands to gain more from gold's price appreciation than anyone else on the planet. So if this really is the debasement trade, America just accidentally hedged itself beautifully. Now look, I'm not saying gold won't keep rising. It might. There are legitimate reasons to own it. Economic uncertainty, tariff chaos, recession fears. Goldman Sachs says 20%, JP Morgan says 40%, one UBS analyst says 93%, and concerns about an AI bubble. Political instability, not just Trump, but government shutdowns, Federal Reserve independence concerns, and turmoil across Europe and Asia. Momentum. When central banks buy and retail investors see prices surging, FOMO is real. But here's what history tells us. Gold is not the stable store of value people think it is. There was a 20-year period starting in the 1980s where gold fell against the dollar. Platinum is 30 times rarer than gold, but trades at a third of the price. Scarcity alone doesn't create value. Demand does. And demand is fickle. Bank of America analyzed gold's current price movement and found only 3 similar surges in history. What followed each one? Corrections of 20 to 33%. One of those crashes was literally caused by central banks selling, only stopping when they signed an agreement to limit their selling. We've already seen gold drop 5% from its peak this week. This safe haven can get remarkably volatile when everyone rushes in at once. So where does gold's price go from here? Honestly, I have no idea, and neither does anyone else. If political tensions cool, a trade deal with China, a government reopening, gold could pull back sharply. If yields rise, ironically signaling Treasury weakness, gold might actually cool off too. But if tensions escalate, if we do hit a recession, if political instability deepens, gold could keep climbing. The truth is, gold's price isn't based on fundamentals. It's based on sentiment, on thousands of years of historical inertia, on collective belief that this particular shiny metal has value, and sentiment is impossible to predict. Look, I'm not saying you shouldn't own gold. Some investors buy it as insurance, a hedge against tail risks. They're willing to potentially lose money for the peace of mind that, if everything goes sideways, they've got something tangible. That's a valid strategy. But if you're buying gold because you believe the debasement narrative, that the dollar is collapsing, that we're returning to a gold-based monetary system, that this is a one-way ticket to riches, you need to understand the risks. Gold has had 20-year losing streaks. It can crash 30% after surges like this, and the data simply doesn't support the most extreme versions of this narrative. So, yes, we're in a gold rush. But before you line up outside that dealer or dump your savings into gold ETFs, remember, rushes are exciting, chaotic, and unpredictable. Sometimes people strike it rich. Sometimes they just end up with spray-painted plastic that looks like the real thing. What do you think? Is gold a relic of the past or the future of money? Let me know in the comments. And if you found this helpful, hit that like button. It genuinely helps the channel grow. As for me, I'm hedging my bets with this $5 gold chain from Amazon. Best investment I've made all year. Thanks for watching. Stay curious, stay skeptical, and, as always, be safe out there.